What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are discussing the fact that the Treasury dollar will most likely be the currency that replaces what we currently call the dollar, which is actually a Federal Reserve note. So we're going to be looking at what does that mean? What are the implications of that? What will that change about day-to-day life? Will that actually fix any financial mayhem, madness, the currency crises that we're experiencing right now? And what, if anything, needs to be done to prepare for an event like that taking place? Let's dive in. All right, so before I dive into the details and kind of the background on this, I want to let you know a very brief overview of the basic bullet points that you need to know about a Treasury dollar replacing the Federal Reserve note as the U.S. currency. Bottom line, it really won't change much about the day-to-day interactions of people. Whenever a currency reset is taking place or there is a currency failure replaced by a new currency, really the only thing that happens is the government sets an exchange rate and says, if you give me a certain amount of the old currency units, I'll give you a certain amount of the new currency units. And now by law, everybody uses the new one instead of the old one. In essence, that's what's going to happen here. As far as I can tell, it will be a new dollar that's called a Treasury dollar. It's issued by the Treasury instead of the Federal Reserve note, which we currently call dollars. They're actually notes that are issued by the Federal Reserve. And finally, no, it won't really fix any of the issues that are caused by our current leaders, our fiscal policy, our monetary policy, and in all likelihood, it'll make things a little bit worse. Now, I am wearing my End the Fed shirt, which is probably something in a case like this that would actually happen. You'd have a dissolution. You'd have the Federal Reserve dissolved or at least folded underneath completely the Treasury by an act of Congress in order to make this legal. And in that case, I'm sorry to say, I actually wouldn't want to end the Fed. There are some loopholes that they're going through to do what they're doing right now that, they're not constitutional, they're not really legal, but having to go through those steps and go through those loopholes is a little bit of a barrier to things happening if by law they just change things, fold everything under the Treasury, and then the Treasury can do everything the Federal Reserve is doing now just without any of those loopholes, any of those legal restraints. For a very quick background and a very quick historical overview, the Federal Reserve was started to kind of be a bank for the banks because there were lots of little banks, and then if there was a crisis, really there would be a run on the bank because a bank would hold gold in reserves and they would issue out loans in currency. But if depositors all at once wanted to go redeem their currency for gold, well, there would be a run on the bank because banks always issued much more in their banknotes than they actually held gold in reserves, and so there would be a run on the bank, and the bank would close down if everybody wanted to collect at the exact same time. That's called fractional reserve banking. Now, in order to prevent this from happening, the big banks got together and they basically said, hey, we need kind of like a bank of banks so that we will not be susceptible to bank runs, because that way, if one of us has a bank run, then all of the other banks can kind of make up for it and deliver our reserves instead through the Federal Reserve. And we'll all use the same currency. We'll all use the same notes, which are going to be issued and created by the Federal Reserve. And instead of each of us having to keep the exact perfect amount in reserves, we can rely on the Federal Reserve to do that for us. Now, before you go trolling in the comments section, of course, I'm skimming over a lot of details here, and there's going to be inaccuracies in any brief overview of something complex when you condense it into 3 sentences. But in general, that's what happened. And so now the Federal Reserve is the one with the onus for keeping the gold in reserves and issuing out the currency. Well, fast forward through the Great Depression and World War II, and now you have the Federal Reserve kind of acting as the banker for the entire world, because now the entire world uses dollars, knowing that the United States keeps all the gold, and anytime we want, we can just swap out our dollars for gold. We all know how that turned out. They printed way more dollars than they should have. The rest of the world caught wind, tried to get their gold in return. Then Nixon said, nope, we don't want to give you the gold. Now there's no more restrictions on how many dollars the Federal Reserve can print because there's no reserve requirement for gold that they hold to back up any of those dollars. Now, around the world, there have been plenty of central banks and plenty of governments that have had currency failures where because of something like a war or an economic crisis, they print too much money to pay for things, and it collapses their currency. We're seeing that right now. We've seen it in Zimbabwe, Argentina, Venezuela, but we've seen it in the past, especially like in the case of Weimar Germany, which there are a lot of correlations right now between us and Weimar Germany. This has happened plenty of times, and many times what the governments try and do is they try and issue a new currency to replace the old failed currency. Now, a lot of times you're going to hear people, not in the financial mainstream, but if you are watching this video, you've probably heard people talk about a currency reset. And this is never something that's done with foresight, never something that's really done intentionally or planned. This is always reactionary. So anytime a currency resets in any country around the world throughout history, it's really just in response to, hey, our last currency failed, it collapsed, and it's worthless now, so we're going to have a reset by creating a new currency. Now, there are two outcomes from this historically whenever a country has done this. The first outcome is the government says, hey, all right, you give me 1,000 of your old paper currency. In our case, let's just say the dollar. You give me 1,000 old dollars and I'll give you one new dollar. So an exchange ratio of 1,000 to 1. Sometimes it's much higher. And it's always a big ratio like this. It's never just a 1-to-1 because that completely defeats the purpose. If you were doing a 1-to-1 ratio, hey, if you got $1 million of the old dollar, I'm going to give you $1 million new dollars. Well, you're creating the exact same supply of the new money. You're creating the exact same quantity of that new money, so it doesn't solve the problem, because the problem is there was way too much money created on the last run around, and it made it worthless. And so the only way to create a new, you have to do a much lower quantity of the new money in order to solve that problem. Now, in this first example, you give me 1,000 of the old ones, I'll give you one of the new one, and it's just the same exact thing. It's just got a better quantity, a better supply right now. Ultimately, the success rate of that happening is 0, because that's literally just like creating larger denominations of the old money. There's nothing intrinsically that has changed with that. Now, the other alternative is, hey, you give me 1,000 of the old ones, I give you one of the new one, and every one of these new ones is backed up or redeemable in something that's physical that has intrinsic value, usually gold or silver. Now, anytime that option has been taken by a government or a central bank, it works. And the only time that doesn't work is when they make the ratio too large and they don't actually have the reserves to back up that new currency. And so when the redemptions start coming in, again, it collapses, because same problem as before. They don't actually have enough. It's just paper. It's worthless. And so if it's actually backed by enough gold or silver in the new with the new currency, then it sticks and it works. Now, right now, obviously, like I showed you before, the Federal Reserve has no gold or silver. It's not backed up. None of the dollars are backed up by anything of physical value. And so the idea is that the Treasury taking over this, if the Treasury starts to issue their own money, whether the Federal Reserve is folded in or just dissolved and the Treasury completely takes over, that would solve the problems. And they'll likely try to go this route. They'll likely try and say, hey, all the problems that we just saw over the last couple of years, or however long this takes, were a result of the Federal Reserve not having the legal power to do what they needed to do with the money, and blah, blah, blah. And so by giving the Treasury all these powers that the Federal Reserve used to have, and eliminating some of the loopholes and eliminating some of the legal restraints, and just streamlining that authority through the Treasury, we're going to eliminate the problems. And so we don't need to back up the Treasury dollars by anything like the Federal Reserve notes used to need to have something to back them up. So we're going to say the change by giving it going full through the Treasury will be enough to grant those Treasury dollars value. And so they'll likely try and go this route and say we don't need to back it. Again, ignoring hundreds, thousands of years of history of this same type of thing happening around the world in different countries. Ignoring that, they're going to say, hey, we don't need to back up the new money with anything, because they still want to be able to print this money as much as they need to in order to finance whatever they want. And so they're likely going to do that, and then the new Treasury dollar will likely fail. Now, the treasury dollar is not actually something that is new. Our country has had the treasury dollar multiple times in the past. And in fact, the most popular instance of this was called the greenback. And that was how Lincoln funded the Civil War. It was a treasury issued currency. It was a treasury dollar. And so there is historical precedence for this. And so once the Federal Reserve note collapses and really fails, I don't see there being any legal resistance in order to put this power back underneath the Treasury and try and issue new fake fiat paper currency as Treasury dollars instead of through Federal Reserve notes. Now, just in case you missed it, what are the problems with this? You're going to, through this currency collapse, you're going to accumulate dollars that are going to become worthless, right? Because if you have $10,000 in your savings account right now as kind of a rainy day fund, anytime a currency fails, the way that looks is that things just get more expensive. And so right now, $10,000 might buy you, a month or 2 months of expenses. But in a year or in 2 years or in 3 years, that same $10,000 amount of dollars, that's only going to buy you maybe, a week worth of expenses, or maybe one grocery trip, or maybe 1 ounce of gold. And so things get more expensive. That's really just too much money coming into the system, devaluing the value of the currency relative to all the stuff. And so if you hold on to dollars, not dollar denominated assets, if you hold on to dollars, like in a savings account or physical bills, the amount of stuff that those will purchase over time goes down. If you hold on to assets, those will go up in price compared to the dollars because it'll take more dollars to buy those things. And if you owe money to somebody, then it gets easier to pay that back because dollars become more plentiful. And so you're paying back dollars that are worth less than the dollars that you originally borrowed. And if somebody owes you money, then you get the raw end of that deal. You get paid back in with purchasing power that was less than what you originally lent. And so in a currency failure, you want to be in debt, at least if you use that debt to buy assets. You don't want to have other people owe you money, which would be like if you're a saver, if you own CDs, or if you own bonds. That's people owing you money, and you're going to get paid back in less purchasing power than what you originally lent, and so that you don't want that in a currency failure. You do want to own assets, and in real value terms, you'll probably still lose money. There'll still probably be a crash in terms of like if you're measuring it with how much stuff you can buy. If you own a bunch of shares of Apple or Amazon or the S&P 500, ETFs like SPY. You'll probably still have a drop in value in terms of what stuff you can buy with that amount of shares, but ultimately it won't be near as bad as the currency because it's going to go up in terms of the currency. Now, in a currency failure, when they issue the new currency then, so if they get rid of the Federal Reserve notes and issue treasury dollars in its place, a lot of times that just pretty much essentially wipes out the debt because it's really easy to get your hands on dollars to pay off debt that you owe. So in terms of purchasing power, it's kind of technically a debt jubilee. It wipes out the value of debt. Now, in the example before, let's say you have $100,000 in your savings account, and when it finally fails, that $100,000 today might buy you a lot of stuff, but in a currency failure, it eventually will purchase you zero. It'll become worthless. And so when you swap out that $100,000 for, let's say, 10 of the new dollars, when you give them 100,000 Federal Reserve notes and you get in return 10 new treasury dollars, those things purchase the same amount of stuff. That's why that's called an exchange ratio. They purchase the same amount of stuff. That's why you can exchange them for each other. And so it's not like you get your same purchasing power that you had 5 years ago. And so this is why holding something like gold that keeps its value throughout currency resets and failures all throughout history for thousands of years, if you hold gold instead of dollars, that will give you the ability to purchase new treasury dollars with your gold. There'll be an exchange rate, just like right now there's an exchange rate between gold and Federal Reserve notes. There's an exchange rate between Bitcoin and Federal Reserve notes. So if you hold a hard asset that is inflation protected, then when the new currency comes around, you can just use your hard asset to purchase the new currency as needed. And so you really protect yourself against being exposed to that currency failure. And you never want to jump all in on that new currency once it's issued because, like I said, they have a really, really bad failure rate. They fail all the time, especially when they're not backed by anything. And I anticipate that the Treasury dollar, when it finally does replace the Federal Reserve note, won't be backed up by anything of intrinsic value as well. Now, at this point, obviously, this is all speculation because while there have been papers written about this and there is historical precedence for a Treasury dollar in the United States, and there's historical precedence for new currencies replacing failed currencies all throughout history around the world, obviously nobody has a crystal ball. And so that's why it's even more important to make sure you're holding assets that have intrinsic value, that are not overvalued by historical traditional measures and metrics, because that will give you the best bet to be able to protect yourself in the case of the madness that looks like it's almost for sure going to be coming here. Now, one last thing here that I want to mention, just in case you haven't seen yesterday's video. This is something that up until yesterday I haven't talked about on my YouTube channel at all. But one thing that I do is I work with people individually, one-on-one, over video calls. Whether it's financial education or looking at investment portfolio allocation or developing a financial plan or looking at trading strategies. And so I do work with people one-on-one, and I manage this through my Patreon account. And I'm letting you guys know because my time slots are actually starting to fill up. And so my monthly ones are actually full now. So those are completely full. And unless one of my current monthly ones decides to stop, there aren't going to be new monthly ones opened up. But I do still have some time slots available. They're filling up quickly, but I do still have some available for my quarterly ones. And so if you're interested in working with me one-on-one to, whatever, portfolio allocation, trading strategies, basic financial education, whatever it is, if you want to meet once a quarter with me over video, go to my Patreon. The little Patreon button shows up at the end of every one of my videos, but I also have it linked in the description below. So if you weren't aware that I was doing this, or you are aware and you just haven't gotten around to doing it yet, wanted to let you guys know, just since you guys have been my subscribers and viewers for so long, wanted to let you know that I do this just in case you weren't aware, and just in case you're interested, because the slots are filling up, and it's one-on-one. And so these times, it's not like I can just open up more slots. It's actually just constrained by the time that I have available to commit to this. And so if you're interested, go check it out. I assume they'll fill up pretty quickly here. So now that I'm mentioning it on my channel, so go check it out, and don't wait because they're going to fill up quickly. That's all for today. Really appreciate you guys. Thanks for watching. Have a great day.